understanding your profit margins. Do you as a business owner actually understand your profit margins? Do you know how it's affecting how much you're paying yourself or even your cash flow? So Josh, I brought you on the show here again today. We've been doing this series here in which we've been helping entrepreneurs around the world as well as in Canada and the US to figure out how to beat the odds. How do you get into that top 4% that succeeds in business? And Josh is, top CPA in Canada. He's also most sought after CFO in Canada. Josh, can you explain to the business owners why is it so important to understand your margins?
Well, the profit margin is the lifeblood of your business, right? If you do not have profit margin, you do not have cash flow. Right? It doesn't matter how much sales you have, if there are no margins on those sales, we're just getting further and further in the hole. And as you know, the second most common reason for a business, failing is running out of cash. So we need to understand these margins.
So then, Josh, what is the average, the average profit margin of most businesses that you encounter? You deal with thousands of clients.
Yeah.
What would you see as the average profit margin?
The average profit margin is going to be around a third.
Okay.
So you're going to have in that kind of, 30, 35, 40% range. You'll see lower averages if you look up stats online, right? Yeah, I think we have a stat in the book of, the average construction company is about 22%, and medical might be, 33%, right?
Correct.
These are on the low end, but people have to understand that those margins are skewed by larger companies, right?
Right.
You have very large profit, very large construction companies, for example, operating at a 4% gross margin, who are doing billions of dollars in projects, so that 4% profit margin works really.
Right.
When you start to get into most small businesses, so think about businesses, and when I say small, I mean,
right,
less than $1 million, even less than 10 million in sales, still
right,
small, right?
Okay, less than 50 employees, and maybe like around about the 5 to 15 employees?
5 to 50 employees, 50. Really.
Okay. Yeah.
And normally they are going to live and die in that 1/3 profit margin, where I have very few successful stories that I could tell you of people who have less than a third in a gross profit margin. So if they're operating at a 25% margin, might sound pretty good.
Yep.
When you start to understand that profit margin has to go and cover the other overhead and administrative costs,
right,
there's very, very left for the net margin at the end of the day.
Okay, and then the net margin is where the business owner finally gets paid, correct?
That's right.
So then that leads me to the next question that we get all the time is how does that affect, how much you get paid as a business owner, or how much it affects you who get paid as a business owner?
Well, here's where it is, and it gets a little bit of, it takes a little bit of discipline,
yes,
and time to really understand this, where just because you generate $1,000 in sales,
well, you can't just take that $1,000.
We can't take $1,000 out of the company, even though there's going to be $1,000 that's going to hit the business bank account.
Right.
We don't have $1,000, right? If we're only, for every $3,000 we're selling the customer,
right,
if there's only $1,000 left in gross margin, so after we pay the employees and the supplies that were directly involved, right, in making that sales, the rent would be an overhead charge, so
okay,
it would be different from that.
Right.
So you think about your direct costs of sales, and these are generally the wages,
yes,
the subcontractors,
yeah,
and the products or supplies that are directly involved in either delivering that product or service.
Okay, makes sense, yeah.
And then below that, then we have all the other overhead costs. We have the rent, we have the administrative employees, we have the marketing. All of those come below, but we're talking about just that gross profit margin. Usually most businesses, they're generating $3,000 in revenue.
Right.
They only have about $1,000 after they pay all of those direct expenses, and those direct expenses tend to be in proportion to what those sales are. So when it goes back to that owner's pay, they have certain overhead expenses, and let's say, right, that they're covering their overhead expenses with their level of sales. That means if they want to pay themselves $1,000, we would think just for a second that, right, they need to generate $3,000 to generate $1,000 of gross profit.
Just gross profit. Forget about even paying themselves, yeah.
So, but if we want to pay the owner, we got to also consider taxes.
Right.
Okay. So we write about in the book where the average business owner is probably, $4,500 or so.
Correct.
In extra sales to pay the direct cost of those sales,
yep,
and then pay the taxes, and then get $1,000 after taxes.
So let's say that again. That's $4,500 in sales, gross sales.
Yes.
Just for a business owner to take home about $1,000 for
That's
themselves.
roughly, it'll change from industry to industry, project to project.
Painting with broad strokes here, correct.
Broad strokes, yeah. For most small businesses, it's in and around that $4,000 to $5,000 level.
Wow.
How much they're going to have to sell to get an extra $1,000 from their business.
Okay, so Josh, then I know this is a common mistake even I did as a business owner myself when I first came to you as a client, and that is, my personal expenses. I was making, money was coming in, it was doing good, but we were spending quite a lot on personal expenses.
Yeah.
And when you deal with hundreds, if not thousands of business owners right now, how do you see that affecting the business owners? Them not knowing their profit margin is probably the root cause, and then after that, them overspending with their personal expenses.
Yeah.
How does that make a business go bankrupt?
Well, really those personal expenses will starve that business from cash.
Okay.
Because anything you take out of the business, if we go shopping or we
Upgrade
go on
a car,
trip or
we go on a
something
trip,
like that,
yeah.
it's not really helping us generate any more sales. And at the same time, we've also given a big chunk of that to the government.
Correct.
Which doesn't help anybody. It doesn't help us. We don't get any
Doesn't
enjoyment
increase
from
sales,
us and
yeah.
doesn't increase sales. So it's the worst kind of expense, right?
Right.
So we really have to understand those personal expenses. If we could avoid those personal expenses,
Or delay it? Would you delay it for now?
delay,
Yeah.
even $1,000 in delayed personal expenses, it's not uncommon depending on where their tax scenario is, that they could have at least $1,500 to invest in their business, because we're talking about pre-tax dollars. Okay?
Correct.
So that
Correct.
same business owner who, they want to upgrade a car, for example, they'll have no trouble taking on an extra $1,000 a month car payment. And then when you tell them to run $1,000 of ads in their business, they act like you're asking them to go to the moon.
Right.
And we have to look at those personal expenses that aren't necessary.
Yes.
If they're not necessary, are they starving our baby business? That baby business that we want to grow up into a big giant someday. If they're starved in their infancy, they're never going to get to that level.
So in all these videos here, Josh, you normally give the business owners, by the way, if you haven't checked out the other videos in our series, just click the I button on the top left here. And also, comment below, ask Josh any follow-up questions that you may want to know more about this topic. I'll get Josh to specifically come back and either make a follow-up video or actually reply directly to you in the comments. Josh, what are some action items for a business owner right now? If they're just getting started, wow, I've just had a wake-up call here, I need to understand my profit margins. What should I do to understand my profit margins?
Step one, we got your revenues. That's really easy. Most people have their revenues at the top. They get that. But they have kind of a loose definition of what are their direct costs and what are their overhead costs, right?
Right.
Think of your overhead costs. These are things that do not go up or down based on how much sales you have directly.
Right.
And eventually you double the size of your business. Now you need a bigger office space, right?
Yeah.
But your direct costs, these are, I spend more hours working because this client ordered this product or service, right?
Yeah.
I had to buy more product. I had to buy more food for my restaurant because more people ate. That's a direct cost. So it goes up and down in relative proportion to the amount of sales that you're doing. It's generally wages.
Yep.
It's generally subcontractors,
Right.
and it's generally actual materials that are used, right?
Okay.
So once we understand what those revenue are and we understand what those direct costs are, we deduct those direct costs and we get our gross profit, right?
Right.
We need to understand that number, and that number as a percentage of total sales, right?
Okay.
Because the overhead costs, whether you sell twice as much next month or not,
Right, yeah.
your receptionist still costs the same amount.
Yep.
Your rent was still the same amount, right?
Yes.
So that's a separate bucket to understand. So you need to become very clear on, what is a direct cost that varies with sales and what's an overhead cost that generally doesn't vary directly with sales.
Can just a general CPA or a bookkeeper answer that question, or does someone have to do that themselves?
A good bookkeeper, a good CPA can help you identify what those are. Sometimes there's a little bit of subjectivity on what a direct cost can be, and it takes a bit of a judgment call to understand that. You might have one person in your organization who's sometimes, building the widgets and sometimes doing the sales, right?
Right.
And sometimes we need to prorata their salary. Right?
Makes a lot of sense. Well, again, if you enjoyed this and you have any questions for Josh, type in the comments below. And once again, we will see you in the next episode.